All right, welcome to This Explainer. Today we're tackling the invisible machinery that literally decides whether a business thrives or, well, goes under. Cash versus accrual accounting. And look, I know what you might be thinking, accounting, yay! But this isn't just math, guys. It's the lens through which a company views its very survival. Every single decision a founder or investor makes, it hinges right on understanding these exact rules of the game. If you want to truly grasp how an organization operates, manages its resources, and proves its health to the world, you absolutely have to decode this divide. So let's jump right in and unpack the actual mechanics dictating the financial heartbeat of the market.
But before we calculate a single profit margin or, dive into complex ledgers, we first have to lay down the competence foundation of accounting. Think about what a business really is on paper for a second. It's basically a chaotic storm of daily transactions, invoices, and receipts flying everywhere. Raw numbers are just noise, right? They don't tell a coherent story all on their own. This competence foundation, it's the agreed-upon grammar that transforms all that financial chaos into a readable, actionable narrative. It's the essential framework that founders and analysts rely on to actually understand the mechanics of business performance. Without it, you're flying completely blind.
So let me pose a fundamental question to you. When exactly does a business actually make money? I mean, it sounds incredibly simple, doesn't it? But the answer is where things get really dangerous. See, accounting isn't just counting beans. It's this fascinating system of timing. It's all about that crucial gap between doing the actual work and finally getting paid. Historically, that fatal time delay is exactly where businesses die. No joke, a shocking number of highly profitable companies have gone completely bankrupt simply because they misunderstood the timing of this gap. How an organization defines the exact moment they make money totally rewrites their entire financial reality.
Okay, let's dive right into this. Every single organization out there faces a massive fork in the road. They've got to choose between two entirely distinct philosophies for tracking their financial pulse, the cash basis or the accrual basis. Let's ground this in reality for a second. On one path, imagine a local freelance graphic designer, right? They finish a logo, get handed a check, boom, transaction complete. That's the cash basis. Super simple. On the other path, imagine a massive manufacturing plant building, say, airplane parts. They order raw materials, build for months, ship the parts, and then wait 90 days for payment. That level of complexity demands the accrual basis. It's literally two completely different ways to view the exact same timeline.
So let's break down how each path actually handles revenue. The cash method, it keeps things incredibly straightforward. Revenue is recognized strictly when the cash physically hits your bank account. But let's look at a real-world scenario here. Imagine you land a massive $10,000 consulting contract in December. You do all the work, but the client doesn't actually pay you until February. Under the cash method, your December looks absolutely terrible on paper, and February looks like a massive triumph. Under the accrual method, though, revenue is recognized the moment it is earned, so December is rightfully recorded as the triumph because the work was done, completely regardless of when the check finally arrived in the mail.
Now, what's really interesting about this slide is how expenses perfectly mirror that revenue logic, and the implications here are massive, guys. Under the cash method, an expense is only recorded when the money actually leaves your account. Makes sense, right? But let's consider the danger and, frankly, the power of the accrual method, where expenses are recorded when they are incurred. Imagine your tech startup orders $5,000 worth of server space in November, but you promise to pay the vendor in January. Under accrual, that cost is formally taken on immediately. That instantly changes your tax liabilities and your profit margins on paper for November, even though not a single dollar has actually left your bank account yet. The absolute key to mastering the accrual method requires a total psychological shift. You have to completely separate the concept of cash from the concept of value delivery. Actually, scratch that. It's more like realizing cash is just the shadow of value. The crucial triggers here are the words earned and incurred. When exactly do those happen? The literal moment that goods are delivered to a customer, or when services are fully completed? The shipped box leaving the warehouse, or that final handshake after a consulting gig, that is the trigger. In the accrual world, the action of delivering the value is what forces you to record the numbers. You completely bypass the bank notification.
So what does this all mean for you? Why does this matter, and who uses what? Well, the reality of the business landscape kind of dictates your choice here. A solo plumber operating on the cash method? Totally fine. Keep it simple. But as you'll see, the cash method is considered non-GAAP, meaning it doesn't align with generally accepted accounting principles. The second you want a bank loan, venture capital, or, to take your company public, investors demand the accrual method. Medium to large businesses absolutely must use this GAAP standard because it stops companies from artificially hiding expenses or inflating revenues just by shuffling their payment dates around. Investors need the unvarnished truth of value creation.
plain and simple.
And I've got to say, this powerful framework we've been walking through, it was developed by Professor Ueda at the Pinnacle Development. His approach is brilliant because it just strips away the noise and the intimidation that's so often associated with corporate finance. It's precisely this kind of structured, fundamental breakdown that empowers beginners and seasoned pros alike to really grasp the essential mechanics of accounting. By defining the rules of the game so clearly, it lets anyone truly understand the language of business without getting bogged down in the minutia. It gives you the absolute clarity needed to see right through the spreadsheet and understand the actual operational reality of a company.
All right, we've covered a ton of ground today in this explainer, from the foundational grammar of accounting all the way to the specific triggers of value delivery. So, as we wrap up, I want to leave you with a sharp, provocative question. Think about your own ventures. Which timeline should dictate your business? Are you playing the short game, managing only the immediate reality of the physical cash in your wallet? Or are you building a scalable empire, managing the complex, GAAP-approved reality of value earned and incurred? Because the method you choose doesn't just track your money, it literally dictates your future, your valuation, and your ultimate survival. Thanks so much for tuning into this explainer, and keep learning.